Welcome to the deep dive. We're jumping straight into a fantastic stack of sources you shared: articles, research, notes, all really centered around money.
Yeah, it's a great topic. Always fascinating.
But this isn't, your typical finance show about balance sheets or interest rates.
No, not at all.
This is a deep dive into the why we make the choices we do with money. It's all about the messy human psychology behind it.
Exactly. Wealth, greed, happiness.
Yeah.
It's all tangled up in there.
So our mission today is to kind of slice through this material you sent, pull out the really insightful bits, and try to understand these surprising links between our minds and our money.
Right. Less a how-to guide.
Definitely. More an exploration of the human side of finance. Human nature, really, just seen through this lens of money.
And the sources jump right in with some amazing contrasts.
They really do. Like, you've got this story of a super educated, successful executive who's somehow just goes broke. And right next to it, the story of a janitor. Quiet life. Becomes a multi-millionaire just by investing.
It's incredible, isn't it? What does that tell you?
Well, what do you think it tells us?
I think it tells us the core idea in these sources is spot on. Doing well with money. It's not mainly about how smart you are or, how much fancy financial training you've had.
Right.
It's overwhelmingly about how you behave.
Okay, unpack that executive story a bit.
Well, this guy, apparently worth $100 million at one point.
Yeah.
Story goes, he's in a hotel restaurant, breaks a lamp, maybe a $500 lamp,
Okay.
and he just, loses it, throws $5,000 cash at the manager and says, "Get out of my face."
Wow. Just pure ego or anger.
Yeah, the sheer lack of control, that kind of emotional reaction over something small. That behavior, if it's repeated, it's just financially disastrous.
Yeah.
And yeah, he did go broke later on.
Okay, so contrast that with Ronald Reed.
Ronald Reed, I mean, what a story. Grew up poor, first in his family to finish high school. Apparently he hitchhiked there every day.
No way.
Yeah. Worked as a janitor, gas station attendant his whole life. Simple jobs.
But he saved.
He saved. He invested. Really consistently. Simple ways. Blue chip stocks mainly. And when he passed away, fortune over $8 million.
$8 million. From a janitor's salary.
Mostly left to charity, too. His Wikipedia page actually lists him as philanthropist, investor, janitor.
That's amazing.
The investor part, purely behavioral, patience, frugality, consistency over decades and decades.
So the takeaway is really clear then.
Yeah. A genius who loses control. Financial disaster waiting to happen. An ordinary person, but with those solid behavioral skills, patience, long-term view, they can build incredible wealth.
Behavior beats brains.
When it comes to money, often, yeah.
That's a really powerful place to start. And it brings up this other key idea from the sources, this difference between money as physics and money as psychology.
Right.
Like, think about medicine or something. Healthcare. Huge advances based on science, right? Biology, chemistry. There are clear rules, things that work predictably. Mostly.
Empirical evidence.
Yeah. But money. We often teach it like it's physics. Here are the laws, the formulas, plug in the numbers, get the right answer.
Yeah, the optimal portfolio, the efficient market.
But it doesn't act like physics in the real world, does it? It acts way more like psychology.
Totally. It's driven by emotions, by our personal histories, social pressures, all sorts of subtle things that just don't fit neat formulas.
It confuses people because it is psychology. Everyone thinks about it differently because we've all had different experiences, different emotional triggers.
Exactly. It's like this giant ongoing experiment in human behavior, watching how people deal with risk, confidence, happiness, greed, all through money. One source called it one of the greatest shows on earth.
Okay, so if it's psychology and it's rooted in our individual experience, where does that come from? How does it get baked in?
Well, that leads straight into the power of our personal history. It acts like an anchor.
An anchor.
Yeah. Our view of the financial world is just deeply, deeply shaped by what we've personally lived through. And that direct experience, it's way more powerful, more convincing than anything you just read about or someone tells you.
So what seems totally crazy to one person...
Yeah. Might seem completely logical to someone else.
Yeah.
Just based on their past.
Give me some examples from the sources.
Okay, well, someone who grew up really poor, they're going to think about risk and saving completely differently than, say, the child of a wealthy banker. It's just baked in.
Makes sense.
Or imagine living through hyperinflation, seeing prices double every month. Your whole view on holding cash versus borrowing money. Fundamentally different from someone who's only ever known stable prices.
Right. Or the Great Depression generation versus, say, kids who came of age in the dot-com boom of the late 90s.
Exactly. Those experiences leave a permanent mark on how you see the world financially.
Yeah.
There was a big study mentioned, looked at 50 years of data, found that how much risk investors are willing to take depends heavily on their personal experience with market returns during their lifetime. Not just intelligence or education. It's partly just the dumb luck of when and where you were born.
Wow. So that bond investor, Bill Gross.
Yeah, even he admitted how much his success was tied to the simple fact that interest rates were falling for most of his career. That was the environment he experienced. It shaped his whole approach.
So it really isn't about who's smarter. It's about different lives teaching different lessons.
Precisely. And you, listening right now, you know things about money from your life that I don't know from mine.
And vice versa. We all have these unique perspectives.
Yeah.
Okay, let's talk about that lottery ticket example, because that really illustrates this point.
Oh, yeah, that's a powerful one. Americans spend, what, billions on lottery tickets?
More than movies, music, games, books combined. It's huge.
And who buys them? Mostly lower-income households, spending way more proportionally.
Often the same people who'd struggle to find, say, $400 for an emergency.
Right. So if you've never been in that situation, buying lottery tickets looks completely irrational. Why throw money away on those odds?
But the sources say try to see it from their perspective.
Exactly. If you're living paycheck to paycheck and the traditional paths to wealth college, good job, saving, seem completely out of reach.
Or even just affording a decent vacation or a new car without crushing debt.
Yeah, that lottery ticket. It might be the only way you feel you can buy a tangible chance, even a tiny one, at getting some of the good stuff. It's not just a financial calculation.
It's buying hope.
It's buying a dream, however unlikely. And that decision isn't made on a spreadsheet. It's made, like the source says, at the dinner table, factoring in your history, your hopes, your pride, everything.
Okay, that idea of hope and circumstance, it kind of brings up another tricky area, luck and risk.
Oh, yeah. The elephants in the room in finance. Always there.
But hard to really quantify, hard to accept, almost.
Very hard. We like stories where skill and hard work are all that matter, but luck and risk play huge roles.
The sources use that Bill Gates and Kent Evans example.
Right. Two incredibly smart, driven kids at Lakeside School, both brilliant with computers. Gates goes on to co-found Microsoft. Evans tragically dies in a climbing accident before graduation.
Just bad luck. Life roulette, as the source called it.
Exactly.
Yeah.
Similar potential, vastly different outcomes due to chance.
Then you have figures like Cornelius Vanderbilt.
Yeah. Supposedly saying, what do I care about the law? Ain't I got the power? It worked for him. He built an empire.
Oh.
But wow, that's a thin line between bold and just. Reckless.
Or Benjamin Graham, the father of value investing.
Yeah, his huge win with Geico stock made him a fortune. But it broke all his own rules about diversification. It was a massive, concentrated bet.
Did he see it as skill or luck?
He himself wondered. He said something like, was it one lucky break or one supremely shrewd decision? Can we tell them apart? It's often really hard to know.
Especially when things go wrong. Was it a bad decision or just bad luck, just the price of taking risk?
Exactly. In real time, it's incredibly difficult to diagnose. We prefer simple stories, cause and effect. Randomness is uncomfortable.
Which makes that Bill Gates quote so potent. Success is a lousy teacher. It seduces smart people into thinking they can't lose.
Yeah, when things are going great, you feel invincible. You forget the role luck might have played.
But if you acknowledge luck helped you succeed,
then you have to accept that its opposite, risk, is always lurking. Things are rarely as good or as bad as they seem forever. Mean reversion is a powerful force.
And acknowledging that risk, that things can go wrong, that ties into knowing when you have enough.
Yes. The power of enough. So simple, yet so hard.
There's that great story Kurt Vonnegut told via John Bogle. Vonnegut's at a fancy party thrown by some billionaire hedge fund manager.
Right.
He tells his friend Joseph Heller, the author of Catch-22, see that guy? He made more money yesterday than you made from your entire book.
And Heller's reply.
Heller just says, yes, but I have something he will never have. Enough.
Wow. That's profound.
It sounds almost quaint, but it's incredibly important. The danger is risking what you have and need for something you don't have and don't need.
And so many brilliant people fall into that exact trap. It's astonishing.
Like Rajat Gupta.
Perfect example. Former CEO of McKinsey. Global figure. Worth, $100 million? More than enough for 10 lifetimes.
Easily.
Yet he risked everything. Reputation, freedom, family, everything he needed, and presumably cherished. For more money he absolutely didn't need. Insider trading.
Ended up in prison. Lost it all.
Yeah. Or look at long-term capital management, LTCM, the hedge fund that blew up in the late 90s.
Run by Nobel Prize winners, right? Financial geniuses.
Exactly. They were already incredibly wealthy personally, tens, hundreds of millions, but they took on insane amounts of leverage, chasing even higher returns they didn't need.
And lost everything. Nearly took down the financial system.
And Warren Buffett had that great quote about them. To make money they didn't have and didn't need, they risked what they did have and did need. And that's foolish, plain and simple.
So what are those things you have and need that money can't buy?
Well, the sources list them. Reputation, freedom, independence, family, friends, being loved by those you want to love you, happiness.
Those are the real valuables.
Absolutely.
Yeah.
And they're never worth risking for any potential financial gain. Knowing when you have enough means knowing when to stop moving the goalposts, stop taking risks that could destroy those priceless things.
Okay, so if the goal is to build enough without taking those kinds of crazy risks, how do you do it?
Well, this brings us to compounding, but not just as a math equation.
More like a force of nature.
Kind of, yeah. The sources use this great analogy of ice ages.
How does that work?
It starts with just a tiny change in Earth's orbit, making summers slightly cooler. So a little bit more snow survives the summer without melting. Just a tiny bit.
Okay.
But that little bit of extra snow reflects slightly more sunlight, which leads to slightly more cooling, which means slightly more snow survives the next summer, and it just compounds.
Over thousands of years.
Over millennia, until you get continents buried under miles of ice. Extraordinary results from tiny, persistent beginnings. It's the persistence over time that creates the magic.
So how does that apply to finance? Warren Buffett.
Buffett is the perfect example. His incredible fortune isn't just because he's a brilliant investor. Plenty of people have had amazing short-term track records.
Right.
It's because he's been a brilliant investor for an incredibly long time, since he was like 10 years old.
His secret is time.
Exactly. His annual return, around 22% over 70-plus years, is amazing. But Jim Simons at Renaissance Technologies, his fund compounded at like 66% a year.
Way higher.
Way higher. But Buffett is vastly wealthier. Why? Because Simons only did it for maybe 30 years. Buffett had an extra 40 years for that compounding to just work and work and work. Longevity is key.
Okay, so that highlights the absolute importance of survival. You have to stay in the game for compounding to do its thing.
You got it. That's the most critical piece.
You need to endure the bumps, the recessions, the crashes, the personal stuff life throws at you.
Without being forced out. Without having to sell at the worst possible time, because you have to.
That quote from Michael Moritz at Sequoia Capital.
Yeah, only the paranoid survive. He said their success came from always being afraid they'd go out of business. That fear kept them prudent enough to last through the downturns.
So survival is why holding cash, even if it earns almost nothing, can sometimes have an infinite return.
Exactly. If that cash buffer prevents you from being forced to sell your stocks during a crash just to pay the bills, it saved you from potentially catastrophic losses.
So a good return, sustained for decades without interruption.
Beats a spectacular return that gets wiped out every so often because you couldn't hang on. Endurance wins.
Which means we need to plan differently, not just assume everything goes smoothly.
Right. Plan, yes. But the crucial addition is, plan on your plan not going according to plan.
Build in buffers. Expect surprises.
Absolutely.
Yeah.
I mean, just think about the last 20 years. Could anyone's financial plan from the year 2000 have possibly predicted 9/11, the housing bust, the GFC, the massive bull run after that, a global pandemic shutting everything down?
No way. Impossible.
So a good plan has to embrace the fact that the future is unknowable. It needs room for error.
What does that look like practically?
It means avoiding fragility. A fragile plan is one that needs specific things to happen exactly as predicted to work out.
Like needing stocks to return exactly 10% every year or never losing your job.
Right. Room for error means having a buffer, maybe extra cash, maybe more conservative assumptions, maybe just flexibility so that you're still okay even if things go wrong or if completely unexpected stuff happens.
Like the card counting analogy in the sources.
Yeah, perfect analogy. Even if you have a statistical edge playing blackjack, you can't bet your whole bankroll on one hand.
You need enough money to ride out the bad luck streaks.
Exactly. Because bad luck will happen, even if the odds are generally in your favor over the long run. That bankroll, that buffer, is your room for error.
So room for error isn't just being timid or conservative?
No. It's what gives you endurance. It lets you stick around long enough for the odds for compounding to eventually work in your favor. It protects you from the unknown unknowns.
Then leverage is the opposite.
Leverage is the exact opposite. It magnifies small risks, turns survivable bumps into potential ruin. That's why the barbell idea can be smart. Be super safe with the money you need, and only take bigger risks with money you can truly afford to lose.
All of this really drives home that we aren't just robots making calculations.
Not even close. We're people. Emotional, sometimes irrational, living in a messy, real world.
Financial decisions don't happen in isolation. They involve our jobs, our families, our neighbors.
Yeah, who we want to impress, who we feel pressure from, it's all part of the mix.
That story about Harry Markowitz is perfect here. The Nobel Prize winner for portfolio theory.
All right, the guy who basically invented modern portfolio optimization.
So how did he invest his own money? Did he use his super complex models?
Nope. He said he just split it 50-50, half stocks, half bonds.
Why?
Because, he said, his goal was to minimize my future regret. He knew how terrible he'd feel if the market soared and he missed out, or if it crashed and he was fully invested.
So 50-50 felt like the least regrettable option emotionally.
Exactly. It was reasonable for him as a human being, even if it wasn't perfectly rational, according to pure math. It accounted for the real pain of regret.
And the sources argue that's often more important, being reasonable versus purely rational.
Yes, because sticking with a plan long-term requires endurance. And sometimes being reasonable helps you endure. Like using extreme leverage might look rational on paper if you assume you can just dust yourself off after getting wiped out.
But nobody does that. It's unreasonable in reality.
Totally unreasonable. So choosing a strategy you can actually stick with, maybe one that feels comfortable or aligns with your values, even if it's not optimal, that might be the more effective path.
Like the home bias example, investing more in your own country.
Right. Maybe not perfectly diversified globally, maybe not purely rational. But if that familiarity helps you stay invested during scary times instead of panicking, then it's reasonable for you.
Or people who, like, dabble in day trading with a tiny bit of money.
Yeah, terrible odds, totally irrational financially. But if it satisfies that itch to gamble or be active, and it keeps them from messing with their main retirement portfolio, maybe it's a reasonable outlet, behaviorally.
It's acknowledging the human element needed to stay the course.
Exactly. Even making forecasts, which we know are usually wrong, it feels reasonable because we crave some sense of predictability.
And that Jack Bogle story, investing in his son's expensive fund.
Violates everything Vanguard stood for. Completely irrational on paper.
But totally reasonable as a dad.
Totally reasonable. It shows that context matters. Relationships matter. Emotions matter. Success with money requires working with our human nature, not pretending it doesn't exist.
Okay, so if we're driven by psychology and history, what does that mean for using financial history to predict the future?
It means history is useful, definitely. But it's not a map.
Yeah, so?
Well, it's great for calibration. Understanding the range of possibilities, seeing common patterns, learning from past mistakes, very valuable for context.
But not a precise guide to what's next.
No. Because finance isn't like physics or geology where the underlying laws are constant. It's driven by innovation, by changing human behavior. Relying too heavily on the past assumes the future will just be a repeat.
And the sources give reasons why that's wrong.
Two main ones. First, tail events.
The big surprises.
Yeah. Rare, unpredictable events that have absolutely massive outsized impacts. Things like 9/11, or Sputnik kicking off the space race, or a pandemic, or a major technological breakthrough like the internet or vaccine.
Things you just couldn't see coming from past data.
Exactly. And their consequences ripple out and compound in ways that are impossible to foresee. Daniel Kahneman said the lesson from being surprised isn't just, don't make that mistake again. It's, the world is surprising. Expect the unexpected.
Okay, tail events. What's the second reason?
Structural changes.
Yeah.
The actual rules of the game change over time.
Like how?
Think about retirement savings. The invention of the 401k and the Roth IRA fundamentally changed how millions of Americans save. Or venture capital, it basically didn't exist 50 years ago. Now it totally drives how startups get funded.
So data from before those changes, it's less relevant.
It's less relevant for predicting how things work now. The structure of the economy, the tools available, regulations, they evolve.
So that famous phrase, it's different this time, often said sarcastically.
Right, usually mocking someone who ignores past bubbles. But the sources argue, sometimes, it actually is different. And those structural changes and potential tail events are often what matter most going forward.
Okay, that makes sense. Now, Related to predictions in psychology, why does pessimism seem so much more compelling than optimism in finance?
Ah, yeah. Pessimism often sounds smarter, doesn't it? More sophisticated.
It does. The sources had that wild example.
Yeah.
A Russian professor predicting the U.S. would break apart in 2010.
Yeah, in the Wall Street Journal. At the height of the financial crisis, gloom, parts going to China, Mexico, just totally apocalyptic.
And it got serious attention. Optimistic forecasts rarely get that kind of headline treatment.
No, they don't. Pessimism is just easier, more common, more persuasive for a few reasons. First, money is universal.
Affects everyone.
Right. Bad economic news feels relevant to everyone, even if you don't own stocks. A hurricane might only affect one region, but a market crash feels like it touches us all.
Okay, what else?
Second, the timing. Progress is usually slow, gradual, almost invisible day to day. It compounds quietly.
Like that Ice Age analogy again.
Exactly. But setbacks, destruction, they're often sudden, dramatic, impossible to ignore. A plane crash gets way more attention than the millions of safe flights. A market crash overshadows years of steady growth.
So negative stories are easier to build from recent vivid events.
Right. Optimism often requires looking at long-term trends, which are harder to see and less exciting. Pessimism just points to the latest crisis.
Plus, pessimism often ignores our ability to adapt, right?
Totally. Problems create incentives for solutions. People innovate. Remember all the peak oil scares in the 2000s? Pessimism said we were doomed. Then came fracking technology, and suddenly oil production surged. Pessimism assumes things stay broken.
And there's that idea of narrative damage.
Yeah, that's important. Sometimes the story itself causes harm, like the 2008-2009 recession. Physically, the U.S. probably had more capacity to produce wealth in 2009 than 2007, more technology, more skilled people.
But the economy collapsed.
Because confidence collapsed. The negative narrative took hold and caused real economic damage, even when the underlying potential was still there. Fear freezes people.
And when people are scared and information feels scarce.
They become willing to believe almost anything, especially if it sounds certain or comes from an expert.
Sure.
Bernie Madoff's impossibly consistent returns, people wanted to believe. TV pundits making confident predictions, people listen, even if the track record is awful.
Which circles back to needing that room for error, that independence, so you're not forced to grasp at straws in a panic.
Exactly. Okay, so we adapt, but we also change as individuals. Let's talk about our evolving selves.
Ah, yes. The idea that we're bad at predicting who will be in the future.
Really bad at it. Psychologists call it the end of history illusion. We tend to think the person we are right now with our current values and desires is the finished product. We underestimate how much will change.
Can you give an example?
Sure, think about a common career arc. Someone goes into, say, corporate law purely for the money in their 20s.
Okay.
By their 30s, they realize they hate the 80-hour ranks, so they switch to a lower-paying government job for better balance.
Makes sense.
Then in their 40s, maybe they decide to become a stay-at-home parent because childcare costs are insane. Another shift in priorities.
Right.
Fast forward to age 70, they look back and realize that the cumulative effect of all these decisions made by different versions of themselves with different goals means they didn't save enough for retirement. Each step felt right at the time.
But the long-term plan got derailed because the person changed.
Exactly. So the big question is, how do you make long-term financial plans for savings, investments, career, when you know the future you, who needs that plan, will likely want different things out of life?
It's a really tough problem. What do the sources suggest?
One key idea is to try and avoid the extreme ends of financial planning.
What do you mean by extremes?
Like planning for a life with an extremely low income, forcing intense frugality forever. Or the opposite, dedicating your entire life to maximizing income, sacrificing everything else, time, health, relationships.
Why avoid those?
Because extremes make regret more likely as you change. The intense minimalist might later crave more comfort or options. The workaholic might deeply regret missing time with family. The benefits of extremes often fade as we adapt. But the downsides, the lack of resources later, or the lost time, those stick around as regrets. Balance provides more flexibility for your future self.
And being willing to change course.
Yes, embrace sunk costs. Just because your 25-year-old self set a specific goal doesn't mean your 45-year-old self has to stick to it if it no longer fits. Be willing to abandon plans made by a past version of you. Don't let a stranger, your past self, dictate your future.
Okay, so weaving through all these different threads, behavior, luck, enough, survival, change. Is there one core goal that stands out?
I think there is. Across all these sources, the idea of independence keeps coming up as maybe the highest form of wealth.
Independence, just the ability to control your own time.
Pretty much. The ability to do what you want, when you want, with who you want, for as long as you want. That kind of control over your life. The sources argue it's priceless.
More valuable than fancy stuff.
Way more valuable. Using money to buy time, to buy options, provides a level of deep, lasting happiness that very few material goods can match. Remember the author quitting that prestigious internship?
Yeah, because he couldn't control his schedule, even though the work was okay.
Right. Having just enough savings gave him the option to walk away. That option, that control over his time, was worth more than the high salary.
And this ties into the difference between being rich and being wealthy.
Exactly. Rich is often about high current income, maybe lots of visible spending, flashy car, big house.
Okay.
Wealth is different. It's the savings, the assets you haven't spent. It's the income you don't turn into consumption. Wealth is what gives you those options, that independence, that control over time. It's built by suppressing today's spending for tomorrow's flexibility.
So wealth is kind of hidden.
Often, yes.
Yeah.
It's the car not bought, the upgrade not taken. And crucially, you don't need a specific goal, like buy a house or retire at 65 to build well.
Just save for saving's sake.
That's one of the most powerful reasons to save. That unallocated pool of savings is your buffer against the unknown. It's your hedge against life's inevitable surprises. And that is what truly buys you independence and control.
Okay, related to spending and wealth, let's touch on that paradox of social comparison.
Ah, yes. The keeping up with the Joneses trap, but with a twist.
People often chase wealth, buy expensive things, hoping for respect, admiration.
Yeah, they want to signal success. They want people to think highly of them.
But the irony is...
The people they're trying to impress often don't admire them specifically. They admire the thing. They use that display of wealth, the fancy car, the big house, as a benchmark for their own desires.
So you see a Ferrari drive by.
You notice the Ferrari. You might think, wow, cool car. Or, man, I wish I had that car. But how often do you stop and think deeply about the driver inside?
Rarely, if ever.
Right. But the driver might have bought that Ferrari hoping you would admire him. He doesn't realize you're just admiring the car and using it to fuel your own wants.
It's a strange disconnect.
It is. So much spending is socially motivated, trying to keep up, or signal status. But comparing yourself to others based on what you see is totally misleading. You don't know their real financial situation, their goals, their worries. They might be playing a completely different game.
So, if you actually want respect and admiration...
The sources suggest humility, kindness, empathy will get you a lot further than a fancy watch or an expensive car ever will.
Yeah.
Those qualities are what people truly admire in others.
Okay, this has been fascinating, diving into the psychology. To wrap things up, let's look at that historical context the sources provided. How did we end up in our current financial culture?
Right, a quick history lesson helps frame all this. It really starts right after World War II.
Okay, 1945 onwards, what was happening?
Soldiers are coming home, millions of them. They want jobs, houses, families now. And policymakers are absolutely terrified of sliding back into another Great Depression.
So they needed to stimulate the economy.
Urgently. And their main tool, keep interest rates incredibly low. The Fed held short-term rates under 0.4% for 7 years.
Wow, basically free money.
Pretty much. It made government war debt cheap to finance, but crucially, it made borrowing super cheap for regular people too. Encouraging consumption became an explicit economic strategy. Get people spending.
And credit became easier to get.
Massively easier.
Yeah.
The first real credit card, Diners Club, came out in 1950. And importantly, interest paid on all debt, even credit card debt, used to be tax deductible.
So borrowing was cheap and subsidized.
Exactly. And household debt took off like a rocket. It actually grew faster relative to income in the 50s than it did leading up to the 2008 crisis.
No kidding.
Yeah. You had this huge pent-up demand for cars, appliances, homes, because factories had been making tanks and planes.
Right.
Now those factories switch back, start churning out consumer goods, and you have millions of people ready to buy, fueled by jobs and cheap credit. Boom.
A massive economic boom, but the sources say it was a particular kind of boom.
Yes, this is crucial. That post-war period, roughly 1945 to maybe 1980, was marked by rising equality.
How so?
Average wages grew incredibly fast, doubling in real terms. And crucially, the gap between the rich and the poor actually narrowed. The share of income going to the top 1% fell significantly.
So prosperity was widespread.
Much more widespread. Lifestyles became more similar across classes. People drove similar cars, watched the same 3 TD channels, bought from the same Sears catalog.
Yeah.
Your neighbor's life felt understandable, relatable. You measured your well-being against people living similar lives.
Okay, so that sets the stage. What changed?
Well, fast forward to the 1980s and onwards, up to the 2000s. Economic growth returned after the stagflation of the 70s, but it was profoundly uneven.
The gap started widening again.
Massively. Income growth for the top 1%, the top 0.1%, just exploded compared to everyone else. The bottom 99% saw much slower income growth.
But did expectations change as quickly?
No, that's the key point.
Yeah.
Sources call it the big stretch. Cultural expectations formed during that more equal post-war era. The idea that you should live a certain middle-class lifestyle, similar to others, and that using debt to get there is normal, those expectations persisted.
Even as incomes diverged.
Right. So you saw rising incomes and much more visible, extravagant consumption at the very top. Mansions, yachts, luxury brands.
And that influenced everyone else's aspirations.
It seems so. Even if your own income wasn't rising much, the definition of a normal or successful life kept getting inflated by what you saw around you or in the media. The average new house got 50% bigger, car loans doubled, college costs went through the roof, fueling huge student debt.
So people were stretching to keep up.
Exactly. Median wage earners took on way more debt. Household debt relative to income basically doubled, from around 60% in the early 80s to over 130% by 2007. They were using debt to try and maintain or achieve lifestyles their incomes alone couldn't support anymore.
And that debt fell hardest on lower and middle income groups.
Yes, so you have this arc, a period of shared prosperity and accepted debt, followed by a period of divergence where those old expectations led to massive debt-fueled stretching for millions just trying to keep up. Expectations adapted much slower than economic reality.
Wow. That context really does help explain a lot about today's financial pressures.
It really does.
Okay, what a journey. We've covered psychology, behavior, luck, history. Let's try to boil down some of the most actionable takeaways from all these sources. What are the key lessons someone listening can use?
Okay, let's try. First big one, respect, luck, and risk. They're always there. Focus intensely on what you can control: your savings rate, your spending, your own behavior, building flexibility.
Right. Control the controllables. What else?
Less ego, more wealth. Remember, wealth isn't what you spend. It's what you don't spend. It's the gap between your income and your ego. Keep that gap wide.
Good one. Next.
Just save, even without a specific goal. Saving for saving's sake is crucial. That buffer is your hedge against surprise. It buys you independence.
Okay. What about dealing with the ups and downs?
Understand that volatility, doubt, occasional regret, they aren't fines you pay for doing something wrong. They're the fees you pay for the potential returns of investing and building wealth over time. Expect them, accept them, be willing to pay them.
View them as the cost of admission.
Exactly. And related to that, worship room for error, build buffers. Margin of safety isn't just being conservative. It's what gives you the endurance to survive the inevitable chaos and let compounding work for decades.
And finally, thinking about our changing selves.
Avoid the extremes in your financial life. Planning for perpetual poverty or sacrificing everything for maximum wealth. Both increase the odds of regret later when you inevitably change. Seek balance, flexibility. It helps you endure as your goals evolve.
Fantastic summary. What a deep dive this has been. We've really seen how money is just so tangled up with everything: our personal past, our feelings, luck, risk, how we see ourselves next to others.
Yeah, and all playing out against this backdrop of economic history and shifting expectations.
It really underscores that doing well financially isn't necessarily about complex strategies.
No, it's often much more about simple behaviors, managing your own emotions, gaining some perspective, being reasonable consistently rather than trying to be perfectly rational all the time.
Well, thank you for sharing all these incredible sources. This was a really insightful discussion.
My pleasure. It's fascinating stuff.
And for you, the listener, here's a final thought to chew on, building on everything we've talked about. Given how much our own past shapes our financial views, given how truly unpredictable the future is, and given how much we ourselves change over time, how can we possibly build financial plans that are robust enough and flexible enough to survive not just market turmoil, but also the inevitable surprises of our own lives and the evolving world we live in? Something to think about.